your subject is financial strategy and valuation. So here, I hope, right, by now, with the previous lecturer, you have done up to long-term financing, right? You probably are done with discussing the introductory section, which is the overview of financial strategy and policy. You might have, discussed these the different types of financial management decisions, like the investment decisions, financing decisions, likewise, right? Dividend decisions. So you might have discussed them with, the frameworks like BCG matrix and all. And on the long-term financing, you probably uh, have discussed the long-term capital sources, like the share capital, preferred stock, and ordinary stock capital, bonds, right? Um, and the term loans, etc. Uh, I hope you have done bond valuation as well, and you're left only with the share valuation part. Am I right?
Madam, only one day I attend this class. I don't know extra.
Oh, okay. Okay. Even Susanta raised that concern that he was not able to attend many of the lecture sessions. So what we will do is, today we will start off with a fresh lesson, since this is going to be the very first day of our lecture series, right? So as we progress through the lecture series, I'll take couple of sessions to, quickly rush through the concepts related to those two lessons as well. So I make sure that you're going to miss any. Right? So that be fine with y'all.
Hello.
Hello. Yes, Indika.
Yeah, means me also today first day
Ah,
join
okay. This is
this.
your first
Okay.
class, right?
Yeah, first day class because previous lesson also I couldn't follow because some of works in office. Okay, we'll see, madam.
Ah, okay. Okay, that's fine. I mean, we will start off with a fresh lesson, which is cost of capital, right?
Okay.
So once we are done with that, we will, as we progress through the lecture series, I'll take the concepts related to those two areas, and, try to, give a little bit of a glance, and let, give a refresher to that as well. So
Okay.
let's start off with today's session. Today we are going to discuss a new lesson, right, which is cost of capital. Now, you see in your syllabus right now, which has 5 sections actually, where the overview of financial strategy and policy will be accounting for 10%, long-term financing for 15%. So the section that we are starting off today with will be accounting for 25% of the syllabus, right? So that 25 also segregated into several sections, which is cost of capital, which will be the focus of today's session, and capital structure policy, and dividends and the dividend policy, right? So we will be touching upon the concepts related to cost of capital today. Right. So I have already shared the lecture materials with the academic staff, and I hope they have uploaded it to your learning management system. So let me share it with you all. So let's look at the learning objectives of today's session. So first, we are going to learn the meaning of term cost of capital, what it means, and then we are going to identify how important it is in the context of financial management, financial strategy. And then we are going to understand the different components of cost of capital. Now, as you've already gone through, now, since, I mean, I hope all three of you are coming from accounting and finance field, right? There are different sources where the company can raise funds, right? Either through equity capital or debt capital, right? So there's common share capital, preferred share capital, debt capital, right? Through debentures, term loans, etc. So we are going to see what are the constituents of cost of capital, as in capital can be contributed not only through equity but also from other sources. We are going to see what are those sources, and based on that we will be identifying this cost of equity, this cost of debt, and this cost of preferred stock. And cost of equity is again segregated into sub constituents, so we are going to look at that as well, and then we are going to understand and calculate cost of debt and cost of preferred stock. And once we are done with the individual components of the overall cost of capital, we will be learning as to how to calculate the overall cost of capital, which in other words the WACC, weighted average cost of capital. And then we are going to see a new concept. I hope this will be quite new to you, even though you might have touched upon these concepts that I've already mentioned. Marginal cost of capital should be something new concept to you. So we are going to see what it is and how it is different from the normal cost of capital. And then we are going to, a bit of, explain what are the limitations of cost of capital, right? Because now it's going to be an estimate, right? Calculated figure. So what we are going to see what are the limitations and how we can overcome them. So this is the kind of the overall plan of today's session. So guys, what is cost of capital? Now, investors, potential investors or existing investors in a company, right? Normally, they invest in a company with the intention of yielding a return, obtaining a return for that, right? So that's obvious, no? That's what the behavior of a rational investor would be, right? A normal investor who is, they are making economic decisions would expect, right, a return for the money, for the funds, for the resources that they invest in a company. So cost of capital is basically the minimum return that should be there to satisfy, to trigger the investors to invest in the company. So if the company does not offer the investor this minimum return, the investors will be reluctant to invest in the company. So it's kind of a hurdle rate, right? So it is the bar where, the investors will decide, okay, I'm going to invest in this company because this the minimum return that the investor would expect for the investment that he makes in return um, is there. So that minimum return, that hurdle rate, right, is called as the cost of capital, right? So which is actually the opportunity cost, right? So the cost of capital determines the rate of return that the firm must earn on its investment to maximize its value. Now, cost of capital, guys, it is phrased in different terms. Now, you might have heard required rate of return, you might have heard discount rate, right? You might have heard uh, yeah, discount rate, cost of capital. Now all these terms refer to one single meaning, which is the minimum rate of return an investor would expect in return for the resources, for the funds that he or she invest in a company, right? So that is the whole meaning of cost of capital. Now, what is it for? What are the uses? Now, you know what now? The meaning now you know. Now, what is it used for? Now, obviously, we are going to see how to calculate the cost of capital. So, what are the uses of it? Now, in capital budgeting decisions, right? Now, for example, let's say your company has several choices to make with regard to a commitment of resources for a given project, right? Let's say you have 100,000 in hand, so you are looking for something to invest the money. You have project A, you have project B, you have project C. So in order to evaluate the feasibility of each and every project, right, to see what is the most feasible one, so that there you will be using cost of capital for that evaluation, right? In capital budgeting decisions, I hope you have discussed how to calculate net present value, right? How to calculate the profitability index. Now, these, in order to calculate these things, we make use of cost of capital. And analysts and investors discuss the cost of capital. They typically mean the weighted average of a firm's cost of debt um, and equity blended together. Please give me a second. Yes. So, like I said, cost of capital also represents that hurdle rate, right? Where the company should surpass, right, in order to generate additional value. Now, this is the minimum level. So, if the company passes that, if the company achieves it, the remainder, the additional value that it generates would, would add value to the company, right? And the cost of capital concept is widely used in economics and accounting and financial management, right? Uh, with regard to investment decisions, right? In investment initiatives, right? Um, so those are the uses of cost of capital, guys. Right? So it is used for capital budgeting projects, investment decisions, right? So it acts as the hurdle rate, right, where the company will be starting to generate the actual value after surpassing this rate, right? Now, I hope you're familiar with net present value and internal rate of return, right? Are you all familiar with net present value concept? Net present value, are you all familiar? Now, I hope you're familiar with present value and future value concept, and that's basic, right? In your previous levels in this particular course, or in your degree, or I hope you have gone through what present value is, what future value is. I'm not going to explain that under this level. So if you want me to explain that as well, just let me know. But NPV is the net present value is the difference between present value of cash inflows and present value of cash outflows, right? So that is the additional remainder from after deducting the present value of cash in outflows from the inflows. What is remaining is net present value. So when you're assessing several projects, let's say in a capital budgeting decision, several um, investment opportunities you assess, right? Normally the most viable opportunity according to NPV criteria is what? Where the NPV would be the highest. Normally, we consider that a particular investment avenue is feasible if the net present value is a positive figure, right? But when you're comparing several investment avenues, where you will be selecting the NPV with the highest value. So how you calculate the NPV would be the difference between present value of cash inflows and the present value of cash outflows. Now, when you're calculating net present value, right, you are using a cost of capital, discount rate you are using, right? So, guys, now that discount rate, Now you see here the cost of in this particular graph, right? So that shows the relationship between the cost of capital and firm value, right? And you see at a point where this internal rate of return is here. Now, with respect to the NPV concept, right? Internal rate of return is the rate where NPV become zero. Internal rate of return is the discount rate or the cost of capital where your NPV becomes zero. I mean, if you discount your cash inflows and cash outflows using the internal rate of return, right? There your NPV will become zero. I hope you understand, right? Let's say your internal rate of return is 10%, right? So if you discount the present value of if you discount the inflows and the cash flows of a particular investment opportunity, your NPV will become zero, right? So now when it comes to the firm value, right? If the cost of capital of the firm is less than IRR, right? Uh, if it is less than IRR, then your firm value increases. Why? Because now according to the graph, you see higher the cost of capital, lower the value of the firm, right? Now you see here, as you go further in the x-axis, which denotes cost of capital, you see now let's take here. Now this is the intersection point, right? IRR is the rate at which your firm value becomes zero. Now if you go further towards the right side, right, you see the respective firm value to the given cost of capital would be a negative one, right? So now you understand, right? If a new investment earns an internal rate of return which is higher than the cost of capital, which means the internal rate of return, the rate of return for the investment should always be higher than the cost of capital for the firm value to be maximized, right? It should not be lower than the cost of capital. So if it is lower than the cost of capital, obviously your firm value would be a diminishing one.